So you're about to buy a house and there's all these questions about mortgages. What types of mortgage? How much do you take? What's the cost of a mortgage? Well, that's what I'm talking about today, so stick around. Hi, welcome back. My name is Joe Brown. I'm a realtor with Century 21 List with Beggins, located in South Tampa. Thank you so much for being here with me today. As I say before, if you find this information useful, please hit the subscribe button, give it a thumbs up, leave a comment, but most importantly, share this information with your friends and family. And I will say this is an episode that you will want to share with your friends and family who are buying a home. And also, if you've been with me, you may notice a different background. That's because I have to keep my friend Otis on his toes. He never knows where I'm going to show up, and Otis, I'm here today, okay? So when you go to buy a home, on the buyer's contract, you have to state how you're going to pay for the house. Now, some people can pay cash. However, the vast majority of people have to take a loan. And so you identify what type of loan you're going to take. Well, there are so many different types of loans. How do you know what to take? That's what I want to share with you today. So during this video, I'm going to put different graphics up just to help explain what I'm talking about. However, you can send me an email. My email is in the show notes below, and I will send you the full graphic. And it's not secret squirrel stuff. You can keep it, copy it, share it with your friends, keep it for yourself as a reference, okay? So the first that I want to talk about is conventional loans. Now, conventional loans is when you go to a non-government entity. So if you recall, several months ago, I did a interview with David Donaldson, who's the mortgage banker I refer people to, and he is with Van Dyke Mortgage. And in fact, I'll put David's information in the show notes below. But Van Dyke Mortgage is a mortgage banker that has conventional loans. Wells Fargo, the credit unions, all these have conventional loans. Now, you can use a conventional loan, as you can see in the graphic, for your primary residence, for a secondary home, for investment properties. Now, there are some pros to conventional mortgages. One, you don't necessarily have to put 20% down, right? Some loans you can even get 3%. Also, their mortgage rates, interest rates, tend to be lower. They're very competitive. And PMI, which is mortgage insurance, can be canceled once you've paid off 20% of the loan. So let's talk about that, right? Because you'll see on the con side, you have to have PMI. So let's say you take a loan, I'll use round numbers, for $100,000. Well, if you take a loan for $80,000 or less, you do not need to insure that mortgage. However, if you take a loan for more than $80,000, you have to insure that mortgage through mortgage insurance. Well, the conventional loan says once you pay off 20%, you can cancel the PMI. That's a benefit. Now, one of the other cons is you have to have a pretty good credit score, above 600. Now, this is why I tell you to shop different mortgage companies. Don't just call one, call several to shop, because the rules vary at the different lending institutions. The rules vary as to credit scores and what the interest rates are, right? Also, one of the cons, it's really not a con, it's there to protect you, the consumer, is your debt to ratio debt to income ratio has to be about 45 to 50%. Again, the debt to income ratio varies by lender, but what it means is all your total debts, your car payments, student loans, outstanding credit card payments, plus this loan needs to be half of your monthly income. Now, with conventional mortgages, there are two different types. There's a fixed rate. So right now, let's say you can get a mortgage, a 30-year mortgage at 2.8% for 30 years. That is a fixed rate. That 2.8% doesn't change over the life of the loan. And what's nice about that is you can then budget for it, right? That payment's not going to change until you cancel the PMI. Well, you can see the other type of mortgage is a adjustable rate mortgage. So the adjustable rate, over the first couple years of the loan, your mortgage rate's going to be lower. However, it can go up a certain percent over time. And again, the adjustable rate mortgages, there are different limits, right? It can go up only so many percent over so much time. So here's the drawback to that. You know, you've set your family budget, you've set your house budget, but then the payment increases each month. And some families find that difficult to fit in their budget. But here is why some people like the adjustable rate mortgage. They know they're only going to be in the house for 2-3 years, maybe 4 years. So they want to have lower payments, then they know they're going to sell their house and move on. So the adjustable rate mortgage, you may think, oh, that's not for me. It's attractive to some people because they know for sure they're going to move. So let's go to a second type of conventional mortgage, and this is called a jumbo loan. So conventional mortgages have an upper limit. You know, it's around 575, 600,000, somewhere in that range. Again, depending on the lender. Well, let's say you want to buy a house in a more exclusive neighborhood, a more expensive neighborhood, so you need to borrow more money. Well, that's why jumbo loans are here. And jumbo loans, one of the pros is it will allow you to buy into a nicer neighborhood, a more expensive home, and the interest rates are very competitive. Here's a couple of the drawbacks, right? You must put 20% down. You have to have a very strong FICO score, around 700 or above. Again, depending on the lender. Your debt to income ratio has to be below 45%, but then you also must provide proof that you have significant assets. And think about it from a lender's standpoint. If they're going to loan you, let's say $1 million, they want to make sure you're good for it, right? Do you have assets to cover the loan? Do you have the income to cover the loan? So jumbo loans are a conventional mortgage. It's just at the upper end of the conventional mortgage. But let's say, and all these are private. You know, I talked about Van Dyke, and there's Fairway, and there's many, many mortgage companies. But the government also provides mortgages. So let's look at these, right? So the first one I want to put up here is the FHA. So the FHA is designed for people that don't have a lot of money for down payments, and they may not have great credit score, okay? So here's the benefit. Your FICO score, it could be in the 500s, right? But again, that varies time of year and so forth. But let's say your FICO score is around 550, maybe even a little bit higher, right? You'll be able to get a loan. You only have to put 3.5% down. Here's a drawback, right? You must pay the mortgage insurance for the life of the loan. Remember, under conventional loans, you can cancel the PMI once you've paid off 20%. Under FHA, you have to keep PMI for the life of the loan. A second type of government mortgage that's coming up now. Come on, I point so my editor knows when to change the slide, are the VA mortgage. And the VA mortgage is designed for military, people in the military. They can be active service, they can be reserves, they can be retired. What's really neat about the VA loan, no down payment is required. You do not have to have PMI. Here's a drawback though. There may not be a down payment, but there is a fee for the VA loan, and the fee is a percent of the loan amount. So, and again, what that fee is changes over time. So I can't say it's 1% or 4%, changes over time. The second drawback, it's really not a drawback. You just have to show that you are eligible for the VA loan, right? That you have to show documentation that you were served in the military or currently serving in the military to get the loan. What's really neat about the VA loan, so let's say you take VA loan, once it's paid off, you can reapply for a VA loan again, right? So it's not a one-time use. Now, it's a once at a time use, right? So you can't have a VA loan and take another VA loan. You can have a VA loan once you pay it off, you can apply for another VA loan. There's a fourth type of government loan that's coming up now, and it's called a USDA loan. And this is for moderate to low income families who live in rural areas. Now, what's nice about this, no down payment is required for qualified buyers, right? So for USDA, you have to be a qualified buyer, and there's no down payment. Here's a drawback, that you can only buy in USDA approved areas, and you must meet income limits. Now, I will be totally honest with you. I have not dealt with USDA loans. I don't know much about USDA loans, but here's my promise. If you want to find out more about USDA loans, send me an email. I will find the answer for you, or I will refer you to somebody who knows the answer, okay? So I've talked about, 5 different loans, 7 different varieties of loans. So I hope this information is useful. Some key takeaways, right? Number 1, shop the mortgage. If you're going with a non-government mortgage, shop it. Call different mortgage companies, ask what their rates are, ask what their down payments are, ask what FICO scores are needed. Many places have an online system where you can put in your information and it will give you a rate. I've dealt with buyers who have used Rocket Mortgage. I've dealt with buyers who have used Van Dyke. So I've worked with buyers using other conventional mortgage vehicles. So just keep in mind, shop the mortgage because it's a benefit to you. I thank you for being here today. As I said, if you want all these graphics on one page, send me an email. I'll be glad to send it to you. Share it with your friends or family. I thank you so much for being with me today. because I love sharing this information. I get stoked about it because South Tampa, Florida living is awesome.